Greetings everyone, I am Ugin Sumo bearing enrollment number 406. Our group will be presenting on mortgage-backed securities and prepayment risk in Singapore. We will explain how Singapore's housing system works, what drives prepayment risk, the challenges caused by secondary market illiquidity, and our recommendations to improve the overall system of Singapore. To begin, Singapore has one of the strongest and most stable economies in the world, supported by strict regulation from Monetary Authority of Singapore (MAS). With a GDP of over $500 billion and a home ownership rate of 90.8%, Singapore has a very large and reliable mortgage base. Another key component is the Central Provident Fund (CPF), a compulsory savings scheme with over $540 billion in assets. Together, the CPF, public housing through Housing and Development Board (HDB), and private bank financing create a unique dual housing system. However, despite this strong foundation, Singapore's mortgage-backed securities market remains underdeveloped.
I am Sonam Somo bearing enrollment number 303. Securitization is limited in Singapore because banks prefer to keep mortgage on their own balance sheet. Mortgage act as long-term sticky assets that helps bank maintain customer relationships and cross-sell other financial products. In addition, Singapore's banking sector is highly liquid, so banks do not need securitization as a funding tool. Another key barrier is the absence of government-backed mortgage institutions like Fannie Mae or Freddie Mac in United States. Without such a centralized body to pool loans and support secondary market trading, securitization in Singapore happens only occasionally, which keeps the market small and illiquid.
I am Dashanglong bearing enrollment number 347. Prepayment risk refers to borrowers repaying their loans earlier than expected. In many countries, this is driven by refinancing when interest rates fall, but that is not the case in Singapore. Instead, prepayment here is shaped by structural factors, Central Provident Fund rules, and borrower behavior. Most mortgages in Singapore use floating rates, so refinancing rarely produces major savings. Borrowers usually wait until the end of the lock-in period before making large repayments, which causes predictable spikes. Central Provident Fund rules also matter. When a property is sold, borrowers must repay the outstanding mortgage plus all Central Provident Fund used. This means repayment is strongly tied to property sales. Finally, many Singaporeans prefer to pay down debt early using bonuses or savings, leading to frequent partial repayments known as curtailments.
I am Solom Hatun, bearing enrollment number 290. These unique prepayment patterns are harder to manage because Singapore's secondary mortgage market is very illiquid. Investors do not have access to hedging tools such as mortgage-backed security futures or prepayment swaps, and the low trading volume means limited data for accurate modeling. Because of this uncertainty, investors demand a liquidity premium, which raises costs and discourages securitization even further. To improve the system, we recommend 3 steps. First, Singapore could establish a centralized mortgage aggregator to pool loans from different banks and create standardized mortgage-backed securities. Second, better and more consistent reporting of CPF usage, prepayment patterns, and property transactions would support clearer modeling. Third, the development of hedging tools tailored to Singapore's mortgage market would help investors manage prepayment spikes more effectively. In conclusion, while Singapore's mortgage market is large and stable, securitization remains limited due to structural barriers and unique prepayment behavior. Our recommendation aims to build a more active, liquid, and efficient mortgage-backed market. Thank you.